All right, welcome back, traders and investors. This is Kyle Bazzi sitting in for Joel Elconin for the week, guest hosting. Feels good to be back. See everybody in the chat room. Ace, Colts, Luck, one more. Good to see everybody. Nick Shaheen, one of our resident mavens. Up next here we have Jim Lacamp from. He's a senior vice president and portfolio manager with Macroportfolio Wealth Management at UBS. Jim, I was just telling you, I'm a huge fan. I love your big stance on free market and the support there. How are you doing this Monday morning?
Well, we're doing pretty well this Monday morning. The futures are opening up a little bit higher. It's interesting to me, this whole thing about where interest rates have headed. I mean, if you would have taken the January 1 a poll of investors and asked how many of them thought that 10-year Treasury yields would be at 237 midway through the year, a little more than midway through the year, despite the taper, I think almost everybody would have lost that bet. And I think that's one of the things driving the markets here. But when we get through with the tapering coming up here in October, it might be a more interesting story because, as you recall, after QE1 ended and QE2 ended, we had 10% correction, 10% plus corrections in the market both times. So I think we live in very interesting times in the market, but for now we're headed a little higher, at least this morning.
So as we were talking before we got here live, it's a big week for the central banks. Can you explain what's going on?
Yeah, well, we have the Fed minutes. We have Jackson Hole, the meeting in Jackson Hole coming up. And interestingly, on this Jackson Hole meeting, they disinvited a lot of prominent Wall Street economists. It's almost like they're trying to change the narrative by distancing themselves from some of the key economists out there. But we have Mario Draghi speaking on Friday, and the European data has recently weakened. So we're all wondering whether the European Central Bank is going to get more aggressive and ease more aggressively, and what tools they actually have in their arsenal. Conversely, we have Mark Carney at the Bank of England, who has suggested that rates might go up sooner than later, ahead of wage growth, and that there won't be any promises about how many times or how often they raise interest rates. So we're starting to see these key divergences around the world with central banks, and not only that, but we have data that's been weakening in Japan as well. And so how long will it be before they ramp up their program? And I think these are key drivers of the equity markets, and so these are things that as investors we need to pay particularly close attention to.
All right, so it looks like interest rates, you say, are going up, and you're saying that's going to be cause for a correction. So at the end of QE1 and QE2, now we're looking at the end of QE3. You said a 10% correction, or is that kind of just based off the other two?
Yeah, no, it doesn't mean we're going to have a 10% correction this year, but I think we do take note of it and we look for the signs of it. And Friday, the S&P 500 closed back under its 50-day moving average. Looks like we're going to be back above that at least early this morning. And so the market is kind of churning around right now, and it's not unusual. We have a midterm election. And markets usually correct on average of 20% in midterm election years. But if you really narrow that down to midterm election years in which a very unpopular president, a lame duck president, is in office, usually those corrections are rather muted. And instead what you get is a little bit of a bouncing around in the market, which it looks like we're getting now. And they typically start to turn back up in front of the election in late September. So if we can just kind of tread water here for the next month and a half, we might set the stage for one more push in the market. I think we could go higher here by the end of the year, buoyed by perhaps favorable election results. And then we might have to get pretty concerned as we head into the first quarter of 2015.
Let's talk about futures again up here in this pre-market trading. And I read a headline, Russia-Ukraine tensions ebb. What are your thoughts on what's going on over there?
Yeah, if you look at Friday's action, the market was trading actually not bad at all. And then when the news hit that there was Ukraine announced that they had taken care of a Russian convoy, and you had these humanitarian trucks on one side that were on the border, and then all of a sudden it's almost like a Trojan horse. You were allegedly sneaking some supplies, military supplies in another area. Well, the Ukrainian government said that they basically wiped out these military trucks, and Russia denied the whole thing happened. But at any rate, the tension seemed to ease, and so you saw a global rally over the weekend. Asia was up a little bit. Europe is up quite nicely, on average about 1%, and we've got a strong market too. So it would appear, at least for Friday's action, the concerns were these geopolitical issues. I don't think they've gone away, and I certainly don't think you can trust Putin to do the right thing. But for now, they're easing a little bit, and it's back to market action. And it looks to me like the market is trying to hang in pretty well, despite breaking the 50-day moving average on the S&P 500. There's been a lot of bad news, and the market's absorbed it pretty well. So I generally think that's a good sign.
I want to get into a little bit of your free market speak before we get done here. But on the economic front, the NAHB and Wells Fargo Housing Market Index for August will be released at 10 a.m. Do you see anything in housing that should be troubling investors?
There has been weakness in the housing market, and they're starting to loosen standards a little bit. They're starting to reframe FICO scores, and they're trying to loosen up lending standards a little bit. You know, it's odd because I'm here in Texas, and the real estate market is red hot. It's you have basically bidding wars on houses, and then you look at the houses around the country, and it's really not been the case. And I think you can tie it to the Federal Reserve Board. Now you could say, well, what do you mean? They've got an interest rate so low it's easy to buy a house, and that may be true. But what's happened is the job growth has really been anemic, and Fed policy has helped homeowners, and it's helped stockholders, but I don't think it's really helped the rest of the economy that much. And I'll blame the Fed, and I'll blame fiscal policy as well. They've done everything they can to screw up the economy, and there's a lot of things they could do to get the wheels of commerce moving better. But we've had a sluggish recovery, and even though it's gaining a little bit of traction, hasn't really translated to higher incomes for people yet. We lost a lot of construction jobs, which are higher paying, lost a lot of factory jobs, which are higher paying, and we replaced them with burger flippers and waiters. And those aren't higher paying jobs. And so a lot of the jobs that have been created are part-time. Obamacare has really made it uneasy for businesses to hire people. So we've got a sluggish job front. Even as it slightly improves, it's not creating higher incomes, and I think that's hurting the housing market.
Jim, I was going through your Twitter this morning, looking at some of your tweets, and I agree with you on that front of the jobs. We look at the number as a whole, but we're not looking at the actual wage enough. Even though we might be, quote unquote, adding jobs, we're not actually raising the income of the families, which means obviously every number from there kind of follows and tally. How do we, and this is a kind of a broader question, but how do we add those jobs back? Like you said, we're adding the burger flippers, but not the construction jobs.
Yeah, so we would be in a really unique position here if Washington wasn't screwing us up so much. We have a manufacturing base that benefits from cheap natural gas. We have the benefit of doing business, around the world with businesses, but we have the most complicated corporate tax system in the world, the most complicated overall tax system in the world. For small businesses, it's really onerous because they have to hire lawyers just to figure out how to do their taxes right. Then on top of that, you create situations that you have now with Obamacare where you pass the law before it's before it's really even been thought through. Then you stop this part of the law, then you delay that part of the law, and businesses they are still operating from a high position of uncertainty, not only on healthcare costs, but what's going to happen with their tax rates, which have gone up. And so I think if you look at these small business surveys, they say red tape and regulation are the single biggest reason why they're afraid of expanding, spending that money on property, plant, and equipment. And small businesses create around 70% of new jobs. So when you make it so difficult for them to do their job, it's no wonder that they're not creating any new jobs. And I think what we have to do is really simplify the tax code, and then we need to redo the entire Obamacare system to one that makes more sense and isn't so punitive to small business owners.
All right, we got the macro outlook from you here. Only about a minute left before we bring on our next guest. But Jim, with your portfolio and what you're doing with the Macroportfolio, and everybody check into the chat. I dropped Jim's Twitter link as well. I highly recommend you follow him there for great insights. Where are you placing your investors in your portfolio here to take advantage of what the market you're expecting it to do?
We were about 70% invested before this recent sell-off, and we've been slowly nibbling. We still have about 15% cash. I do think, as I mentioned, we have one more leg higher, and so every day I have my watch list. I still like medical areas. Still, I've been re-nibbling at the biotechs. A lot of them corrected, and now they're starting to rally again. Some of these technology companies have very strong earnings pictures. And if you look at companies that beat earnings, beat revenues, and up to their guidance, that's our shopping list. And a lot of those are technology companies, so we're a little heavier there. I do note that the gold mining shares have started to rally again too, even though gold's still in its base. And so, although we haven't bought anything there, we're kind of looking at the gold and silver mining companies again to add in as well. So I think there's places you can play. Corporate America has some bright spots, and but we use stops on everything, and we don't get married to anything. So it's a fluid situation, and I end every newsletter with "Stay nimble, my friends," and I think that's what we have to do.
That's a great point, Jim, is never get married to the stocks that you're in. It's not about what you think. It's about what this market is going to do. Jim, really appreciate you coming on today. Jim Lacamp, Senior VP and Portfolio Manager with Macroportfolio Advisors over at UBS. Have a good one, Jim. Thanks a lot for coming on.
All right, thanks for having me, Kyle. I enjoyed it.